Ladies and gentlemen, California's seniors are being priced out of their home. I know that's no surprise for those of you that originate or live in the Golden State. So today we're going to look at a recent post or an article in the Sacramento Bee, which really lays out the reasons why California homeowners are having to spend over half of their income on their mortgage payment. And you might be saying, well, how does that impact seniors? But there are some definite impacts, albeit indirect. So let's jump in. As we know, owning a home in California does come with a high price tag for many reasons, and many are now spending nearly half their income or even more in some situations on mortgage payments, that according to reporting from Realtor.com. This makes California the third least affordable state in the union. I would imagine that we're only being beaten at least by New York and perhaps another location that may surprise you. They continue, for years, the sound advice was not to pay more than 1/3 or 33% of your income to keep a roof over your head, but that rule has become increasingly outdated, said Realtor.com in a January 29th report. I would add that that rule has been completely obliterated thanks to marginally higher interest rates, but housing prices that have skyrocketed 35 to 45% in many markets across the nation, including here in California. To make matters even worse, the SACB reports that none of California's largest metropolitan areas have a median-priced homes that are affordable for households earning the mean income under the traditional 30% rule. Now, we're going to get into it in just a moment and how older homeowners or senior homeowners are being impacted by this issue that younger home buyers are facing, spending at least half of their income just on the mortgage, principal, and interest alone. And then, of course, you add on your property taxes and insurance, it's going to get insanely expensive. But there's also the challenge with the median price here in California being about $697,000 for a home. That's going to make most income groups ineligible to qualify for that mortgage. According to Realtor.com's report, these are the cities in California that are spending the most of their income on housing. And number one is LA, Long Beach, Anaheim, followed by San Diego, Chula Vista, Carlsbad, all beautiful areas, by the way, Oxnard, Thousand Oaks, Ventura. Then we have San Jose, Sunnyvale, and Santa Clara. So we don't have the Bay Area overlooked, of course, and then Riverside, San Bernardino, Ontario, San Francisco, Oakland, Fremont, Stockton, Lodi, Sacramento, Roseville, Folsom. Number 9 is Fresno, and number 10 is Bakersfield, Delano. Now, many would-be home buyers have become forever renters thanks to this housing crisis, created in large part, yes, again, by, policy decisions made by the Federal Reserve during the pandemic and during the post-pandemic years. These higher prices drive up many costs. Now, we've looked right now at the unaffordability issue for younger would-be home buyers and just what percentage of their income is required to buy a home in the great state of California. But what about the senior homeowners? How are they directly impacted, or I should say indirectly, because they certainly are? The first is property tax bills, and you might be saying, now, wait a minute, Shannon, don't we have Proposition 13 in the state of California? Doesn't that cap just how much those property tax assessments can go up? Well, we certainly do, but let's do some simple math here, and I'm going to look at just one hypothetical example. If you had a home that was valued at $450,000 in 2019, but today it's estimated to be worth about $630,000, how does that impact us? Well, under Prop 13, the property tax rate is capped at 1% of the assessed value, and that brings the effective rate about to 1 to 1.25%. But the assessed value, the underlying number in a property tax bill, thanks to Prop 13, can only increase by 2% each year. Well, we are just looking now at a 6-year or 7-year window, from 2019 to 2026. The 2019 property taxes for a $450,000 home would be about $4,950. However, under 2026 taxes, even with Prop 13 protections and caps, that number has increased to $5,686. And there's where you have a 13% increase in a property tax bill, even with the protections of Prop 13. So, yes, older homeowners are being affected in the state of California. And then think about it. These higher home values are also driving up construction costs, which When it comes to home insurance, these insurance companies are looking at the higher cost of goods and services and materials required to rebuild a home, such as we had with the wildfires in Southern California. So that's also factored in, which is going to further increase property tax charges. So those are just two examples how California seniors are being pressured by high home prices. It's not just young folks that are being hurt by today's median interest rates, but also high home values. Yes, it's seniors as well. Two of the American housing industry's most respected voices, Barry Habib and Logan Muttashami, are now saying that the housing market here in America is poised for a rebound due to a number of factors. This as reported by Housing Wire. It says that the housing market is set for a surge in pent-up demand, and as we know, there has been a backlog of those who have been just sitting on the sidelines, waiting until mortgage payments or home prices become more affordable. And let me just be very straightforward with you. Well, for years, I've anticipated a very significant correction in home prices, or home sale prices, I should say. But the fact is our government's not going to allow for a nationwide collapse in home values because it represents a significant portion of our GDP, but also that is viewed as wealth by these homeowners, even though it's unrealized, and that can also be a political hot potato. During Housing Wire's 2026 Housing Economics Summit, MBS Highway founder, CEO Barry Habib said that the first move downward in mortgage rates could trigger a rush of home buyers who have delayed buying for years. Whenever rates make that next move lower, sales go vertical, he told attendees. It's because home sales have been depressed for so long, and then all of a sudden, rates go lower, and everyone's like, oh, okay, let's all go in. Housing Wire's lead analyst, Logan Muttashami, said that the next significant rate drop toward 5% could unleash buyers who have been waiting for years. We haven't had rates go to 5% yet, he said. You're going to see a rush of people who have been waiting for so many years. It's more about past demand that should have been there. We still have over 162 million people working. We have 5 generations of home buyers that are still here and not going anywhere. Then these industry pros address the question of housing inventory. In other words, if that can be corrected in some meaningful way, would that, reduce prices to the point where many would-be home buyers could actually afford a home? Barry Habib said that inventory, to a degree, can be a wash if the mortgage buyer comes in, so you can get more sellers out there. Now, I'm not saying they're going to create much more inventory outside of that rush, but if you get that seller, he's going to wait for that buyer to come in, and then that person buys the house. Then the inventory is a washout. So to be honest, we have all seen many predictions when it comes to the housing market. I've certainly made my own here at HECMWorld, but most of them have missed the mark considerably. We're in some uncharted waters when it comes to the American housing market, and so the traditional trajectories or prognostications just have not come to pass when it comes to a nationwide trend. However, that said, of course, as I've reported many times, we have several pockets and several metros across the nation where home prices are dropping precipitously, and you can say they're in correction territory. But then here's the best news. If we see that interest rates continue to moderate or even go down significantly in 2026 and home values remain relatively stable, that is a win-win. A win for the older homeowner, and of course, a win for the reverse mortgage lender. And our last story this week is a piece of unfortunate news, at least for our industry's reputation, but good news for HECM borrowers that were harmed or impacted by lapses in servicing. The National Reverse Mortgage Lenders Association reports that reverse mortgage borrowers who had HECM loans previously being serviced by HUB's subcontractor, Novad Management, may be eligible for a reimbursement, or a check could already be in the mail. That is a result of a lawsuit that was brought by the CFPB, or the Consumer Financial Protection Bureau, back in 2024. At that time, the CFPB ordered permanently banned Sutherland Global Services and its subsidiaries, and also Novad from servicing HECM reverse mortgages, and to pay $11.5 million in restitution to those impacted reverse mortgage borrowers. Now, for Sutherland, those penalties are significant. They must pay $11.5 million in restitution to those harmed. along with an additional $5 million civil penalty to the CFPB Bureau's Victims Recovery or Relief Fund. But when it comes to Novad, strangely, they don't have the ability to pay, or at least they claim to, so they have to pay at least a representative damage, and that is of $1, if you can believe that. So despite the curtailment of the CFPB, what this tells us is that HECM loan servicing is still in the crosshairs of regulators, and it will be closely watched. And we've seen, of course, just nightmares, horror stories of people receiving inaccurate notices or false notices of due and payable, which really can put a senior homeowner in a mental tailspin and, of course, the stress that involves. In the final analysis, we have learned as an industry that loan servicing is not just a box to be checked off. It is an integral part of the HECM loan experience, but also it is crucial when it comes to the industry's overall reputation. And loan servicing was a reputational risk for many years. In fact, the vast majority of CFPB complaints filed by HECM borrowers were related to loan servicing.